The trade wars are back, and this time they're spreading across three major fronts. In 2025, the United States has reignited tariff battles with Canada, Mexico, and India. What began as a push to protect American industry has now turned into a complex trade showdown that's disrupting supply chains, raising prices, and leaving businesses caught in the middle. It started with new US tariffs on imports from Canada and Mexico, targeting steel, aluminum, auto parts, and even farm goods. The White House said it was acting to stop unfair competition and revive domestic manufacturing. But Canada and Mexico hit back almost immediately, imposing their own tariffs on American products like pork, dairy, and industrial machinery. Within weeks, the tension spread beyond North America. The US announced new duties on India's textiles, pharmaceuticals, and solar equipment, accusing New Delhi of unfair subsidies. India responded in kind, taxing US farm products and natural gas exports. Now, three of America's largest trading partners are pushing back at once, and the economic fallout is mounting. Let's start with North America. Trade between the US, Canada, and Mexico adds up to more than $1.5 trillion a year, so even small disruptions cause big problems. In the auto industry, where parts cross borders several times before a vehicle is finished, tariffs are raising costs and delaying production. Automakers warn that car prices could rise by $1,000 or more if the disputes continue. Farmers are being hit too. Mexico and Canada are two of America's biggest buyers of corn, soybeans, and dairy. With new tariffs in place, US products are suddenly less competitive. Some Midwestern farmers say orders are already being cancelled, while others are turning to federal aid to stay afloat. And energy is caught in the crossfire. Tariffs on metals and equipment used in pipelines and refineries are driving up costs for US and Canadian energy projects. That could mean higher fuel prices for consumers if the disputes drag on. Then there's the India front, and this one's different. India is a crucial trade partner for the US, especially in pharmaceuticals, textiles, and tech services. The US depends on Indian-made generic drugs and IT outsourcing, while India relies heavily on the American market for exports. But with tariffs rising on both sides, that relationship is starting to crack. US retailers say import costs for Indian textiles are climbing fast, while pharmaceutical firms warn that prices for some medications could increase by double digits. Indian exporters, meanwhile, are losing access to one of their biggest markets. It's a lose-lose situation. So why is the US reigniting trade wars now? Part of it is political. With an election year underway, both parties are promising to protect American workers and rebuild domestic manufacturing. Tariffs are a visible way to show toughness on trade, but economists warn they often backfire, raising costs for businesses and consumers alike. Part of it is strategic. The administration wants leverage as it heads into USMCA renegotiations next year, and as it pushes India to open its markets further to US companies. But using tariffs as bargaining chips risks damaging long-term partnerships. For businesses, the fallout is real. Automakers, farmers, logistics firms, and even small exporters are feeling the pressure. Stock prices in manufacturing and agriculture have already dipped, and some companies are delaying investments until there's clarity. The irony is that tariffs meant to protect jobs often end up hurting them. When production costs rise, exports fall, and companies cut back. Economists estimate these new trade disputes could shave up to 0.5% off US GDP growth this year. Small on paper, but significant in a slowing economy. Meanwhile, the global implications are growing. Canada and Mexico are exploring new trade ties with Europe and South America. India is strengthening partnerships with Southeast Asia and the Middle East. If those deals expand, the US could find itself losing influence in markets it once dominated. Still, not all companies are standing still. Some are diversifying supply chains, sourcing from Vietnam or Indonesia to avoid tariffs. Others are investing in automation and AI to offset higher input costs. In a strange twist, the trade war may actually accelerate domestic innovation. But make no mistake, businesses hate uncertainty, and right now, that's exactly what they're getting. Deals that once took days to finalize now take weeks. Cross-border shipments are being delayed by inspections and new customs paperwork. The friction is growing, and confidence is fading. The broader message from Washington is clear. Trade is no longer about cooperation, but about competition. The US is using tariffs not as last resorts, but as tools of negotiation, a signal that economic alliances now come with conditions. The danger, though, is that this approach may isolate America just as the global economy becomes more interconnected. Allies are beginning to hedge their bets, forming new trade routes and alliances to reduce dependence on US markets. For companies, large and small, the lesson is clear. Resilience is no longer optional. The businesses that survive this new era will be those that adapt fast, diversify suppliers, and build flexibility into their operations. Trade wars rarely have clear winners. They create survivors, businesses that learn to operate in uncertainty, cut waste, and pivot quickly. And right now, as tariffs rise and partners push back, survival may be the only victory that matters. Because in this new trade environment, the old rules of globalization no longer apply. The US isn't just negotiating trade, it's testing loyalty, reshaping alliances, and forcing companies to rethink what global business really means. And for everyone caught in the middle, from factory floors in Michigan to textile mills in Mumbai, the message is the same. The trade war is back, and it's not ending anytime soon.